Good afternoon, ladies and gentlemen. Welcome. Before we start today's session, please take note of the following house rules. All information provided in this webinar is for your general information only and do not contain nor convey any type of legal advice. All materials presented in this webinar belong to the organizers and speakers. This webinar is being recorded and the video will be uploaded onto the SBS video channel. We will share the link with all attendees once it is ready next week. You would be muted by default when you join this webinar. There is a Q&A function on Zoom, which is now opened. At any point of time, you may click on the Q&A button to post your questions to the speakers. At the end of the webinar, for the questions which are unanswered, we will work with the speakers after the webinar to prepare a Q&A info pack. We will share this info pack with all attendees once it is ready.
Global Connect at SBF helps Singapore businesses expand into overseas markets. Since November 2019, we have guided Singapore businesses as they seize business opportunities in Asia and beyond. From identifying emerging trends to closing deals, we provide a full spectrum of overseas business expansion services. With Global Connect at SBF, you can learn about new markets, customers, and free trade agreements across the globe. Land opportunities and scale up in new markets, both physically and digitally. Localize overseas operations to ensure sustainable long-term success. Our Singapore Enterprise Centers in Indonesia and Vietnam also provide on-the-ground business and market development services. We also provide a dedicated digital B2B marketplace to quickly scale your business overseas. With Global Connect B2B, set up your company profile in minutes and start contacting thousands of regional partners and customers. Last year, Global Connect at SBF reached out to over 2,000 companies, completing many overseas expansion projects through its network of trusted business specialists and professionals. In 2021, Global Connect at SBF will also launch new initiatives for Singapore businesses to position themselves on the international stage. Explore business opportunities across ASEAN, South Asia, Japan, and other markets by joining us at Festival, our flagship digital event. Become part of the Global Connect at SBF community today and start enjoying exclusive benefits. Customized business advice, access to our overseas Singapore Enterprise Centers, preferential rates for services, as well as structured training, one-on-one advisory, and assistance on using free trade agreements to extract greater commercial advantages abroad. Global Connect at SBF, connecting your business to global opportunities.
We connect your business to global opportunities. Learn with us about markets, new customers, and free trade agreements. Land with us through our dedicated digital spaces, established networks, and hands-on advice and facilitation. And localize with us through our trusted relationships abroad to deepen your presence and secure your long-term sustainability. Do scan the QR code and visit our website if you want to find out more. The Career Conversion Program for Internationalization Professionals supports enterprises to recruit and train experienced individuals for their internationalization plan. To find out more, scan the QR code, or alternatively, you may reach out to Eddie and Elizabeth via email. In the Asian Infrastructure Finance 2020 report prepared by AIIB highlighted on Asia's infrastructure paradox. This paradox refers to how Asia's poorest countries are also the ones that require the most investment in infrastructure projects. But these same countries also have the most difficulty to attract sufficient capital to fulfill their infrastructure needs. These difficulties are due to the perceived risk to investing in the countries, the possible returns from such investments, and the alternative projects which the same pot of funds could secure a better return from. These are also the same few considerations which any financing institutes will look at when examining a project investment plan. As such, it is important to understand what these key considerations are, and hence prepare accordingly when looking to submit an investment plan. A very good afternoon, ladies and gentlemen. Thank you for joining us at today's webinar. My name is Jeffrey from the Singapore Business Federation, and I am your host for today's virtual event. Today, we are honored to have two distinguished speakers from Clifford Capital and Singapore Business Federation to share their insights on infrastructure financing and internationalization. After their presentation, we will be having a fireside chat between our two speakers to delve into how SMEs could secure infrastructure financing. We will also be having a short Q&A session towards the end of the webinar. So attendees, you are welcomed to start posting your questions using the Q&A function at any time during the entire webinar. If you are a Singapore company exploring on infrastructure financing in Singapore, or are interested to look for collaborative partners, do sign up for our free business consultation session. Simply email my colleague Ziquan, and he will reach out to you for a tailored business consultation session after this webinar to assist you on your inquiries. To start off, I would like to invite Mr. Nguyen Kai, Co-Head Origination and Structuring, Infrastructure, Clifford Capital, to tell us more about securing financing for overseas infrastructure projects. Kai jointly leads the client coverage, deal origination, structuring, and execution for Clifford Capital. He also has more than 12 years of experience in project and structured finance at Mizuho Bank, DBS, and Singapore Power. Kai will share with us on the key considerations in financing overseas infrastructure projects, on how to position your businesses so as to raise financing successfully, and the key features for a project in order to increase its bankability. Kai, please.
Yep. Thank you, Jeffrey, for the introduction. It's a real pleasure to be here. Hello, everyone. I'm Nguyen Kai, and I head up the infrastructure team in Clifford Capital. I'm thrilled to be here, and thank you, SBF, again, for organizing this webinar and inviting us to speak on this interesting topic. I'll start off with a quick introduction of Clifford Capital and talk a little bit on how we typically help Singapore companies with their financing needs. I'll then move on to the discussion topic today, which is on how Singapore companies can successfully raise financing for their overseas infrastructure projects. I think given the time constraints, we have structured today's webinar more as a generic presentation that is not specific to any sector, and we'll be happy to discuss any sector-specific considerations offline. My presentation should take about 20 minutes. I'll be happy to take questions thereafter during the fireside chat. So let me start off with a quick introduction of Clifford Capital. We were established about 10 years back with the support from the Singapore government to help finance Singapore-based companies who are looking to expand overseas. So just to be clear, this means that we can only support overseas projects. We have the flexibility to provide loans across the whole debt spectrum, including project finance loans, secured corporate loans, and asset-backed loans. Because of the support from the Singapore government, we are able to raise funding at a very competitive rate, which we then pass on to our customers. Because of our clear policy mandate to support Singapore-based companies, we are able to offer tailored and flexible financing for small projects which commercial banks may not be so keen on. I think since our inception in 2012, we have committed over 3.3 billion in debt financing to various projects around the world. We have a global remit, and our portfolio is spread across Asia, Middle East, Africa, Europe, and South America. Next slide, please. Just to set the scene, when we talk about infrastructure project, it's actually quite wide-ranging. To give the audience a sense of the type of infrastructure projects that we normally come across, we have traditional infrastructure projects like transportation projects, which includes port and toll roads, power projects, which covers conventional power plants and transmission grids, and oil and gas projects like refineries, gas pipelines, and oil storage terminals. But on top of these, in the recent years, we are also seeing new classes of infrastructure assets. So one big area will be the renewable sector. These are mainly wind and solar farms, whether it's utility scale or rooftops. We will also see projects relating to microgrids, battery storage, and EV charging network. Another big area is the digital infrastructure assets. Along with the digitalization of our economy, we are seeing increased demand for assets like data centers, subsea cables, and fiber network. And nowadays, with the increased emphasis on food security, we are also considering new asset classes like logistic assets and agri-tech assets. Next slide, please. So it does sound like it covers a very wide range of assets. Just to guide our audience a bit more, the infrastructure projects that we typically finance have 4 key characteristics. First, they typically have high barriers of entry. These projects require large initial capex and are bound by contractual and regulatory framework that limit competition in the market. Second, these assets tend to have predictable long-term cash flows. These assets usually have long useful lives, and they are backed by long-term contracts with creditworthy counterparties. Third, these assets usually have inflation-linked revenues so that they can pass on future inflation costs to consumers. And lastly, these assets typically have limited correlation to economic cycles. So even during economic downturns, these assets are pretty much not affected. So with that, I'll move on to the main topic of financing. Next slide, please. Here we start off with a quick overview of the different types of financing that's available to companies. Depending on the stage of the life cycle which the company is at, different types of financing will apply. Typically, when the company has just started out, it has no track record and very limited financial strength. The company's product is likely to be in the pilot phase and market demand is unproven. In these early stages, the company should be looking at venture cap funding or grants or subsidies in addition to the owner's own equity. But once the company is more established, it can then look to tap on the debt market. For most SME owners, the debt instrument that will be most familiar with is a corporate loan. And this can be used to finance anything from working cap to capex. But for infrastructure projects, there is another alternative, and that is project financing, which we'll go into detail in the later slides. If the company's debt capacity is limited, it may raise quasi-equity type of debt like convertibles and mezzanine debt. Alternatively, the company can also look to raise pure equity via family office or private equity market. And once the company has established a strong track record, it can even look to tap on bond markets or go for IPO to raise more equity. So broadly, these are the various financing options that are available. In the next few slides, we will focus on project finance loans, which are typically used to finance infrastructure projects. Next slide, please. So what is project financing? In its simplest form, it's about raising debt via a SPV with loan repayment linked to the cash flow generated by the underlying infrastructure project. If you refer to the diagram to the right, you see that equity owners own the SPV, which in turn owns the underlying infrastructure asset. The SPV is the borrower, and the loan is then repaid via cash flow generated by the asset. So this is very different from a normal corporate loan structure. If you refer to the diagram on the left, you'll see that in a normal corporate loan structure, the equity investor itself is the borrower, and they will have to repay the loan directly. Some of the audience might question, isn't it the same? Since the equity investor will receive cash flow from the underlying asset and use it to pay lenders anyway. So here is the key difference. Under a project finance loan, if the SPV cannot pay, the lenders cannot go after the equity investors. whereas in a corporate loan, the equity investors will be directly liable for the loan. Next slide, please. There are other differences between a normal corporate loan and project finance loan, and we have summarized them in this slide. I'm just going to touch on a few key ones. The first major difference, the amount of debt that you can raise is typically higher under a project finance loan than compared to a corporate loan. And this is especially true for SME clients. And why is that so? I think the quick answer is that lenders will look through the SPV and rely on the credit profile of the project's end customers. And these customers usually have a stronger credit profile than the SME owners themselves. The second major difference, project finance loans usually have much longer tenors than corporate loans. And this means that the repayment of the loan is spread out over a longer period. This is a critical consideration for many of our SME clients. Having a longer repayment period means that the annual loan repayment is less. And so the project can start to pay dividends to the SME owners earlier. This will allow the SME owners to recycle their precious capital faster and use it to grow their business further. There are, however, some drawbacks to project finance loans. The main issue for SME clients is the process of raising project finance loan is much more complex than raising corporate loan. We'll touch on the process a little bit more in the later slide, but what this means is that the project will take longer with higher transaction costs incurred. Next slide, please. In the earlier slide, we mentioned that project finance structures are more complex. In this slide, we'll try to give you a flavor of what a generic structure looks like. I'd like to emphasize that each project will have its unique structure, and what you see here is already a highly simplified one. As you can see in the diagram, the SPV will enter into multiple contracts with various parties. For example, the SPV will enter into an EPC contract for the construction of the project. The SPV will also enter into long-term supply contracts for their critical feedstock or long-term sales agreement for their end product. Some of you might ask, why the need for all the contracting structure? Well, this goes to one of the core principles of project financing, which is to allocate risk to parties that can best manage this risk, and this arrangement is crystallized via these contracts. Just using the construction of the project as an example, the best party to manage construction risk is the EPC contractor. These guys are specialists in their field and they have years of actual experience on the ground. In the ideal case, the SPV will enter into date-certain lump sum turnkey EPC contract with the EPC contractor. Under this contracting structure, any cost overruns will be absorbed by the contractor. Similarly, if there are delays in the construction, the EPC contractor is liable to pay penalties to the SPV. So through this contracting structure, the construction risk is largely shifted to the EPC contractor. Just two more points to note. First, this contractual arrangement comes at a price because the EPC contractor will include a pricing premium to cater for such risk. So the overall construction cost will increase. In our experience, several of our SME clients who are more cost conscious, they struggle with such contracting structure. Typically, the owners who are often entrepreneurs, they have higher risk tolerance and are unwilling to pay for the premium upfront, whereas lenders are more conservative and would prefer a tighter EPC contractual structure. At the end of the day, it's about balancing profitability on one hand and bankability on the other hand. The last point on this is that the credit strength of the EPC contractor must be acceptable to lenders. There's really no point setting up an elaborate contracting structure if the EPC contractor is unable to stand behind its payment obligations. So in a similar manner, lenders will try to shift all other key risks to parties who can best manage this risk. So for example, the supplier is best placed to manage feedstock availability risks, and the insurers are best placed to manage natural disaster risks, and so on and so forth. Ideally, for the lenders, the only residual risk that they're okay to be exposed to is financing-related risks, i.e. assessing the credit risk of the various counterparties. But to be candid, that's really the ideal scenario. In reality, we often come across some residual risks that cannot be allocated. For example, in some projects, the end customers or suppliers might not be keen to fix prices over a long period. So to the extent possible, lenders will try to adjust the financing structure to cater for such risks. I won't go into the details, but basically lenders will introduce some cash reserves or reduce the debt capacity of the project. And in some cases, the SME owners will need to pick up the residual risk. So using the same example of price risk, if the price of the end product falls below a certain pre-agreed threshold, and this results in the project not having sufficient cash to service the loan for that period, and I must stress it's really for that period and not for the entire loan amount, lenders might need the owners to top up the difference. Next slide, please. In the earlier slides, I mentioned that the process of raising project finance loan is a lot more complex than corporate loans. In addition to the contractual complexity that I've just touched on, the amount of information required can be a bit overwhelming. Sorry, Ming Chen, I'm not sure if this is the correct slide. Next slide. Next, yes, this, thank you. Yep. Yes, so I think just to give the audience a sense of what's required, I'll touch on a few key areas. So typically there will be a whole suite of legal contracts which underpin the contractual structure. The financing documents are also more complex. For example, a corporate loan agreement is typically about 30 to 40 pages long, while the loan agreement for project finance can easily run into the hundreds. And this is because project finance loans typically have a lot more restrictions on how the SME owner can run the business. For example, there'll be restrictions on the SPV's ability to enter into an unrelated business or ability to dispose of major assets without the lender's consent. In addition, there will also be periodic reporting that's required. So for example, there will be a monthly report on the construction progress of the project. Second, lenders will need to conduct detailed due diligence on the project. Typically, lenders will engage third-party experts to help them. So this will cover areas like legal, technical, insurance, environmental, and social. The due diligence process typically takes up to 2 to 3 months, with several rounds of back and forth of Q&A with the borrower. For SME clients who are not familiar with the process, the detailed due diligence can be time-consuming and, to be honest, sometimes a little bit frustrating. Third, the borrower also needs to provide a detailed financial model which accurately reflects the cash flow projections underpinned by the various contracts. The lenders will also need to verify the key assumptions through the due diligence work performed. Next slide, please. So this is the second last slide of the presentation, but it's also the most important one, so do bear with me. In this slide, I'll talk through the key bankability issues or the key risks that comes up in most of the deals. To successfully raise financing, all these concerns have to be adequately addressed. Similar to the earlier slide on the project structure, the slide highlighted here are the most common ones that we regularly come across. The first risk that I'll touch on is sponsor risk. There are two key considerations. First is the financial strength of the SME owner. Typically, lenders will require the SME owners to put in some equity in the project to ensure that they have skin in the game. So lenders will want to make sure that the SME owner will have enough money to fund their equity. The second consideration is the sponsor's experience and track record. Because the project will be driven by the SME owner, lenders tend to look out for sponsors with some actual track record. The company may be new, but the people behind it should be experienced. Some of our SME clients struggle on this front, especially if they are a fairly young company with limited resources and track record. The second risk that I'll talk about is supply risk. So lenders typically require the project to have predictable long-term cash flow. To achieve that, lenders often require the project to enter into long-term supply agreement for key feedstock on a fixed price and volume basis. The tenor of the supply contract should also be longer than the loan tenor. a key thing that lenders look out for is the supplier's termination right. Ideally, such rights should be minimal. Otherwise, there's no point in having a contract if it can be easily terminated. Lenders also prefer the project to contract with well-established suppliers. The logic is actually quite simple. A well-established supplier is less likely to breach its obligations under the contract, given the reputational impact. And in the unlikely event that it does, lenders can go after the supplier for damages. All these considerations that I just shared also apply to offtake risk. The third risk that I'll touch on is political risk. Lenders have limited risk appetite for lending into countries with unstable political regime. In particular, there are three key risks that lenders focus on. First, events relating to political violence like strikes and war. Second, the risk that the local government imposes currency convertibility and transferability constraints. So this is especially important for projects that earn local revenue but borrow in hard currencies like US dollars or Sing dollars. With such constraints, the project cannot convert its local currency revenue to pay its hard currency debt. And even if they could convert the revenue, the government may not allow such hard currency to be transferred out of the country. This happens mostly in countries who face a shortage of hard currencies, and the government is trying to preserve the supply of hard currencies to service its own national debt. The third risk is expropriation and nationalization. In the past, when there is a change in political regime, the new government might confiscate assets which are built by foreign investors. Sometimes, such expropriation may be done over time and in more subtle manners. For example, the government could, over a period of time, increase taxes on the project and gradually reduce the project's profit. Typically, when lenders deem that such political risk is high, they will require the project to buy political risk insurance. Such insurance is usually available either from multilaterals like MIGA or private insurance market. However, this insurance is not cheap and they will add on to the project's cost. The fourth risk is currency risk. So this risk arises when the project earns revenue in foreign currency but raises debt in a different currency. This exposes the project to foreign currency exchange fluctuations. For example, if the project earns Indian rupee and has to pay US dollar debt, if the rupee depreciates against the US dollar, the company may not have sufficient US dollar to repay its debt. To mitigate against this risk, lenders typically require the project to enter into FX derivatives to hedge the bulk of its foreign currency exposure. This will also add additional cost to the project. The fifth risk is operating risk. Once the project is constructed, lenders will want assurance that the project is properly operated over the loan tenure. Typically, lenders will require an operator with proven track record to operate the project at least in the short to medium term. During this period, the project's own in-house operation team can shadow this experienced operator and take over at some point. Lastly, on construction risks, we have already touched on this in our earlier slide, so I'll not cover it again. I think the only point to mention that this is often one of the key focus areas for lenders. Next slide, please. So this is the final slide. I appreciate that we've gone through quite a lot of material and it might take some time for the audience to digest. I just want to leave a few key takeaways for the audience. First, infrastructure projects typically require large upfront investment, while the SMEs' financial resources are usually quite stretched. And so the SMEs often face some funding gap. Project finance can help bridge the gap by allowing the SME owner to raise more debt than what the SME owners can raise on a corporate basis. Second, project finance loans have much longer tenors compared to corporate loans. This means the repayment is more spread out. This in turn allows the project to dividend cash back earlier to the SME owner so that they can recycle their limited capital for new projects. However, there are clearly some trade-offs. Typically, extensive due diligence and documentation are required. This translates to higher transaction costs and longer time to draw down. In our experience, the hefty due diligence costs, which can range anything between $500,000 to $1 million, depending on the complexity of the project, and the uncertain outcome is a major deterrent for our SME clients. There is always a risk that the due diligence is not satisfactory, and consequently, the project cannot raise the required financing after spending all that money. So not many SME clients can actually afford to take this risk. Even if the financing was successful, the SME owners will have to live with having more restrictions imposed on how they manage this project. This might be difficult for some SME owners to get used to in the beginning. So that's pretty much the end of my presentation. I hope the audience have found it helpful, and I'm pleased to take any questions during the fireside chat. Thank you. Back to you, Jeffrey.
Thank you, Kai. I think it is interesting for everyone to hear about the key bankability considerations, as it provides insights as to what they need to look out for and how they may have to structure their investment plan in order to satisfy the financiers investment community. Dear attendees, do type in your questions at any point of time during the webinar using the Q&A function on Zoom. Before we move on to the next speaker, we would like to get your thoughts on a few questions. We would like to understand more about your financing needs in the near future and the questions in which you may have an interest in. May I have the poll question launched, please? You will now see a poll with 4 questions on your screen. Please answer all the questions and click on submit. The poll will be up for 5 minutes, so do answer them at your own leisure. We are privileged to have Mr. Darius Lim, Assistant CEO of SBF, with us today. Darius leads SBF's global group, which supports Singapore companies to go global in Southeast Asia and frontier emerging markets. Today, he will be sharing about Global Connect at SBF, the SBF initiative that helps SMEs looking to go global. Darius, please.
Thank you, Jeffrey. Hello, everyone. Just to take a few minutes to share on this, what I feel is a really exciting initiative that SBF started with Enterprise Singapore. There was some information on this in the video at the start, but I'll just highlight, I think, some key points of it. So this program started in November of 2019. So we're running about almost 1.5 years now. Next, please. Next slide. And I thought this would be interesting to share that in that 1.5 years, if you look at the number of market requests, this really has been the total number of requests we have received from companies for assistance on internationalization matters. So this could range from information on markets, assistance for contacts, for successful landings, and so forth. The other interesting figure I thought to highlight was the number of overseas projects facilitated. And this is really what makes Global Connect very unique, in that the success of the program is really tied to the commercial success of the companies we help. What do I mean by that? Under Global Connect, we're not just looking at helping you get introduced to a partner or to connect you to a distributor. A lot of effort is put in by the team to work very closely with you, the company, on your product, your strategy, and also to help with what we call deal facilitation, so that it will lead you to an eventual closure of a deal and hopefully a commercial arrangement in which benefit, actual cash, real outcome, revenue benefit is brought to the companies. So since this program started, we've successfully landed 51 companies. And our target next year is to land 100 companies for Global Connect. Next. In the last 1.5 years or so, the 3,500 requests which we received has been distributed as such. Most of it, understandably, is in Southeast Asia, 1,008 of it, and that principally has been in 4 main markets: Indonesia, Vietnam, Thailand, Malaysia. Because of what we see happening in Myanmar, we've also seen an increase in requests for Cambodia. But what is also interesting is that our Singapore companies have also ventured much further away from Southeast Asia. South Asia being one. We're also seeing strong requests for the Middle East, Central Asia, Europe, and even Latin America. For Europe, a lot of the requests have primarily been in the Central and Eastern European markets, Ukraine, Romania, and so forth. And I'll share some of the initiatives that we've done in the subsequent slides. But what this shows really is that I think our SMEs in particular are quite robust. I think the importance of having access to diversified markets, building their base, I think it's very important. And we see more Singapore companies moving out from Southeast Asia into the emerging markets. And many of these companies can get access to Global Connect, and we are here to help you get access to these markets and succeed. Next. Under Global Connect, SBF established 2 overseas offices. You could say it's SBF's own internationalization. We established one in Jakarta and a second office in Ho Chi Minh. By end of November this year, we'll be establishing a 3rd office in Bangkok. And we have found that these offices have served quite a critical need for the Singapore companies, especially the SMEs, at this time when travel is extremely limited. They have helped companies keep some of the relationships warm, pursue links, build up connections, clarification of regulations. And we do encourage all of you to approach us or the officers directly for assistance, and we'll be very happy to provide the assistance that you require. Next. Next, please. Just a list of some of the companies we've helped. You may notice some familiar names, but I'd just like to highlight that Global Connect really helps all sectors and all sizes of companies. So Q Organics, that's quite a young, small company. M-Line is a steel manufacturer and distributor. It's much larger. We've helped them then in Thailand. We help Q Organics then with a distributor in Vietnam. And we also have infrastructure companies who we have helped and are helping get access into projects and markets in Indonesia and Vietnam. Next, please. Now, because of COVID, I think we also had to think how we could engage the Singapore companies and also share with them information. But the most important is that how do we bring useful outcomes for the companies? So really, how do you match them to overseas partners? So we ran a series we call Festival 2021. I think for 2021, we covered South Asia, Southeast Asia, and we had a key focus on Japan. Next year, we will be focusing on Latin America, Africa, we're also again on Southeast Asia, and we'll be doing for the first time a very dedicated series on infrastructure and energy. So please look out for that. Next. So just quickly, this is some of the initiatives or webinars we did on Latin America. We covered about 7 markets running over a period of 4 to 5 months, and it's still ongoing, taking us up to December. Next. We also ran business matching sessions for Kazakhstan and Uzbekistan. As you know, we received, Kazakhstan has quite an interesting market for infrastructure and also for energy. We received quite a number of requests for that. So we are helping the Singapore companies understand that market better, get connected to useful partners, get connected and access to the projects. Next. And for Central and Eastern Europe, much of the emphasis is still on tech, cybersecurity, big data, e-commerce, and we continue to work on these markets to help the Singapore companies get access to them. Next. Now, part of the effort under Global Connect is also to ensure that we bring the advantages of the free trade agreements, the many free trade agreements that Singapore has, to commercial benefit for the companies. We have an FTA team, and we conduct many one-to-one advisories. We've conducted over 200 so far, I think the last 1.5 years. And please feel free and do contact us. The FTAs that Singapore has really can benefit the companies. It could be a little complex sometimes to navigate, And that's why the team is here to help you with that. Next. So just to also highlight that today's session that you're seeing is really part of a series that we are conducting under the Global Connect effort. We've been focusing on financing, and we've been looking at financing for a whole range of projects, from green buildings to energy, to water, waste management. And we do intend to continue on this. We feel that's a growing space, and Singapore companies are developing a very strong niche in some of these areas. So the team is working and thinking through how we can help all of you get access to the markets, get access to the financing you need, get access to the partners and projects that will help you expand and gain market entry and grow your company and grow your business. Next. Okay. It's a very short brief, but I think there's much that we can talk about. Global Connect, this initiative is really developed and designed for you as a company. So do contact us. We have country heads and market advisors who stand ready to help you. And as I said earlier, the success of this program is really tied to the commercial success of you as a company. So we are looking forward to speaking and engaging with you more. Thank you.
Thank you, Darius. It is good to hear about the program has already connected to more than 3,000 companies and landed more than 50 companies overseas. It is great that SBF is there to help Singapore companies to look at overseas opportunities. Before we move on to our next segment, I would like to share the results from our poll now. May I have the results from the polling session, please? Well, we have almost more than 94% of the attendees who responded saying that they are looking at ASEAN in the near future, and the majority of the deals will fall between 1 to 30 million. So actually, Kai, I'd like to just focus you onto this, the poll results. What do you think about this? It seems like the main interest from this group of audience right now is about smaller investment sizes, and they're all looking at ASEAN.
Yeah, thanks, Jeffrey. I think maybe in terms, I'll start off the second question, which is on ASEAN. I think that's pretty much in line with our experience as well. So I think particularly in ASEAN, we see quite a lot of renewable projects. I think particularly in Vietnam, we also see some of our more adventurous SMEs going to countries like Myanmar and Cambodia. So we do see quite a bit of that. And I think coming back to the first question in terms of the magnitude, just now I think I might have already touched on this. I think if a project is too small, something like 1 to 10 million, it may not make sense to raise project financing, because if you're going to already spend $1 million on transaction costs and your project is 5 million, it just doesn't make economic sense. But I'm also heartened to see that while 42% fall within the 1 to 10 million, we actually have a sizable pocket of projects that are more than 10 million. So 10 to 30, even 30 to 75. And certainly, I think these would be good candidates for project financing. Thanks, Jeffrey.
Thank you, Kai. Yeah, Darius, do you have something to say about this? Because it also seems like there's a fair bit of interest on ASEAN. In fact, the current audience, 94% of them, they are focused on ASEAN actually.
Yeah. No, I think that's good to know. I think a lot of the questions that we see coming up also very deal specific. I think that we'll be very happy to have. I think Kai will probably be addressing them separately after this. But the Global Connect team is ready. I think the infrastructure, especially the energy space, is growing, particularly on the renewable space as well. While Singapore companies may not be able to take on the whole project, many of them have developed, like I said earlier, very special capabilities and niches for these projects, and we'll be very happy to work with them to get them into these projects. Vietnam in particular, I think is going very big on renewables. We also recently saw something earlier on the South Asia side, and I think there's much we can do with them. Thanks, Jeff.
Thanks, Darius. So we'll move on to our next segment. For our fireside chat, I will be passing the baton to Darius to lead the chat with Kai. Darius, please.
Yeah. Thanks, Jeff. Kai, thanks for the very interesting presentation. I think the SMEs have many questions. You hold a key that many companies want. I think you will get invited to many meetings and lunches after this. But let me begin first with, I think, a question that's on everybody's mind. How can the Singapore SMEs qualify for Clifford Capital's support on their financing?
Yep. No, thanks, Darius. Definitely looking forward to the lunch post-COVID. So yeah, so to this is a very pertinent question, right? How can SMEs qualify for our support? So we have a two-step qualifying process. Yeah, I think that's useful to have that chart there. So we do have a two-step qualifying process. So if you look at the top left-hand corner of the diagram, first, I think what we have is a concept of a qualifying company. So what is a qualifying company? It's essentially a company that is either incorporated in Singapore or listed in Singapore. And this company then needs to have 3 or more strategic decision-making functions in Singapore. So it sounds a little bit complex, but actually these are the usual functions that you find in most companies. You have things like business development, finance, legal, HR, IT. So if this Singapore company has more than 3 of these strategic decision-making functions in Singapore, they qualify as a qualifying company. So that's the first step. So once we have a qualifying company, the second step is to figure out whether this is a qualifying project for us. So if you could refer to the bottom half of the slide, there are 2 ways a project can be considered to be qualifying. First, the qualifying company needs to own at least 30% equity stake in the project. So for example, I think just now we talked about Vietnam, right? So if a local SME owns a 50% stake in a renewable project in Vietnam, we can finance that project. Alternatively, if the qualifying company is providing goods and services to the project, we can also support the project. So just to give an example, if our SME is providing EPC services to a water plant in Indonesia, we can support the Indonesian project. So I think it's worth highlighting here that in this case, Clifford Capital will be financing the SME's customers and not the SME itself. Whereas under the first limb of the equity ownership, that's more of the SME themselves. So that's an important point to differentiate. So we've also received feedback from our SME clients, and we have also started exploring construction financing. So using the same example just now, right? So if the Singapore SME is providing EPC services to the Indonesian plant, we are now starting to consider financing the SME during the construction period so as to reduce their working capital burden. And the repayment of the loan will be from milestone payments made by the project. So I think it's worthwhile just to share a few other points on our financing. I think one immediate question that audience might have is the amount of money that we can actually lend. Yeah. So because we cover a wide spectrum of clients, both large caps and SMEs, our usual ticket size is for each transaction ranges between $50 million US to $150 million US. But really for the smaller projects, we are prepared to consider loan quantum as small as say 15 or 20 million. So more often than not, it's not that we don't want to finance projects that have lower loan quantums. It's really the transaction cost of raising project financing that determines whether it makes sense to raise project finance. So just to give an example, right? Just now I mentioned it. If the project is only $5 million, do you really want to spend $1 million on transaction costs? It just doesn't make sense. But if your project is like 20, 30 million, then maybe that 1 million starts to make a lot more economic sense. I think another point to note is that we typically provide loans in Sing dollars, US dollars, and Aussie dollars. I think for other currencies, because we talked about Southeast Asian countries, right? So for other currencies, it really depends on the ability of the cross-currency swap market. Yeah. Thanks, Darius.
Thanks, Kai. And I think given all that's currently happening, I think one question the companies are also thinking about is, so you talk about 50 to 100 million, but has COVID-19, and what's happening in the whole business, global environment affected Clifford Capital's ability or risk appetite when dealing with SME financing? And is Clifford Capital looking to be more involved in SME financing given the complications and challenges you mentioned earlier?
Yep. No, thanks, Darius. I mean, from our end, we definitely see the impact of COVID-19. I think the SME clients have also, or rather the feedback that we get is that I think commercial banks, I think appetite has gone down a little bit. Now that things are improving, maybe that has changed. But I think clearly up to a year back, things were really difficult for them. So for us, I think we cover a very wide spectrum of companies ranging from large caps to SMEs, not just SMEs, just to be clear. And I think for our SME coverage, we usually work very closely with Enterprise Singapore, who is also one of our key stakeholders. I think in the past, most of our SME clients will reach out to Enterprise Singapore, and based on their initial assessment, Enterprise Singapore will then reach out to Clifford Capital. I think this model has worked very well. So Clifford Capital, we are able to leverage on Enterprise Singapore's extensive network to widen our reach to potential SME clients. And we in turn provide relevant financial advice and debt funding for the SMEs who need it. So Enterprise Singapore also acts as a gatekeeper to help us sieve out the more relevant deals. So this in turn allows us to really focus our energy on deals where we can add value to. I think I should also point out at this point in time that depending on their financing needs, not all the SMEs get referred to us.
Right.
Yeah. So for example, if a company is in early stage, I mean, Enterprise Singapore might refer these SMEs to other sources of funding, for example, grants or venture caps. I think going forward, I expect to see more SME involvement in a few growth sectors. So just now we touched on it. I think there was the renewable sector. We are seeing SMEs in the energy efficiency sector, battery storage, EV charging, logistics, and agri-tech. So we definitely look forward to working with these SMEs to support them on their financing needs.
Thanks, Kai. And on that note, you touched on this earlier, but I thought it might be useful just to share a little bit more. I mean, as an SME, what are the key considerations would it be if for an SME when looking to make their projects bankable? I mean, how do we get Clifford Capital interested in this project that the SME has?
So I think maybe just to be clear, I think when we talk about bankable projects, I think the credit standards are the same, whether it's for us, for commercial banks, the same credit standards apply. I think the key difference between us and say a commercial bank is because of our policy mandate. We are more willing and more able to help SMEs with projects that are pretty small.
Okay. And much has been said about the high cost of financing for SMEs comparatively compared to, say, the larger corporations. Now, how would you suggest for SMEs to get around this?
So there is that is actually a tough question. The reason is because financing cost is mainly a function of credit risk.
Right.
So naturally, I think SMEs financing costs will be higher simply because I think their risk is a little bit higher. I mean, the large corps, they have proven track record, they have a stronger balance sheet. I think one way to kind of reduce the financing costs is actually to leverage on the credit strength of the SME's end customer. And this is really what project finance is about. But beyond that, I would also encourage the SMEs to try to tap on the various government schemes that are available. To be honest, we are not 100% familiar with these schemes, and we'll urge the SMEs to actually reach out to Enterprise Singapore to find out more. I think there's another point, which is really depending on the project, there could be subsidized financing schemes that are offered by the multilaterals, people like IFC, ADB or MEGA, or even the development finance institutions, people like KfW and FMO. I would actually imagine for most of the SMEs, these names sound a little bit foreign. And naturally, I think it'll be hard for them to make the connections. But this is where I think we can help, right? We do work with these institutions. We know them well, and we can definitely make the connections. But I also like to highlight that a bankable case is a must before we start discussions with all these multilaterals.
We, under Global Connect, we received a number of requests, or at least interest in projects related to sustainability. And obviously, the financing question arises. So perhaps let me ask you, is it easier for SMEs to secure sustainable linked loan or green financing for say green or sustainability related infrastructure projects compared to the traditional projects or the traditional route of financing?
No, I think Darius, thanks. I think that's a good question. I think it's worth clarifying here. I think when we talk about a green loan, it simply means that the loan meets certain environmental reporting standards. So I think those loans that we talked about, normal corporate loans or project finance loans, all these can be green loans as well. I think that's the first point to make. Second point, I think green loans are very popular now. They tend to attract more interest from lenders, so more liquidity. And sometimes, I want to emphasize, sometimes it comes with slightly lower pricing. It's not, currently we don't see a lot of big difference. It's just maybe a couple of basis points of benefit. But I'd like to emphasize again, I'm sorry if I keep coming back to this point, the underlying bankability is the key. So if you don't have a bankable project, it doesn't matter if your loan is green or not, you just won't be able to raise the financing.
Okay. The other thing that we've seen come up, family offices. Have family offices played a big part towards providing alternative options for financing or for infrastructure financing?
Well, I think there is on my end, I don't really see a lot of family offices coming in. That's possibly because I play in the debt space, i.e. I provide debt. Whereas I think for family offices, I think they're more likely to provide equity or quasi-equity support. This is basically more expensive. And then it will also require the owners to give up some portion of the equity. So based on our experience, some of the SME owners, they guard their equity very closely because they believe in their business so much, right? And so they are not keen to dilute their share.
Right. And Kai, I think with 5 more minutes to go, let me ask you this. If you have just 3 key advice to be given for SMEs who are looking for financing, whether with Clifford Capital or otherwise, what would it be?
Well, I think as a start, I would say it's really important for the SMEs to have a clear business plan in place when they reach out to financiers. Because I think many times we've seen SME clients come to us. They are obviously very good at their business, but they don't really have a clear financing plan or a business plan. I think that's where we see the gap as well. So I would suggest that for them, make sure you have your clear business plan put in paper, and then have a think about what are the broad financing parameters that you need. And then you reach out to Enterprise Singapore and try to explore all the possible funding options. So at the end of the day, I mean, just to be candid, money is fungible, right? Whether it's debt or it's equity. I suspect what the SME owners want is really just cash to fund their growth. So it doesn't matter whether it's debt or equity. So if the SME is looking to finance infrastructure projects, I would then recommend that they should always think about project financing. Like I said, we've worked with some SME clients, and we can see that for them, at least in the initial stage, I think the process of getting there seems very long and sometimes quite frustrating. But then I think the benefits are well worth the effort. And once the SME, I think if they successfully raise their first project finance loans, I think the subsequent ones will be a lot easier.
Thank you, Kai.
Yep.
Thank you. I guess the main message is that project financing is available, especially for SMEs, and entities like Clifford Capital are really there to help these companies access the financing. Kai, thank you very much. I know it's short, but I think you gave very useful information, and we certainly hope to welcome you back for some of our other engagements. And I'm sure the SMEs will be contacting you after this.
Yeah, thank you, Darius.
Thank you. Jeff, back to you.
Thank you, Darius and Kai, for this insightful chat. I believe this has been very useful for our audiences. And we still have a fair number of questions which are unanswered in our Q&A panel. but we will look to work with the speakers after this webinar to prepare a Q&A info pack, and we will share the pack with the audiences once it is ready. So now we are coming to the end of our webinar today. So on behalf of the SBF, I would like to thank Kai and Darius for joining us today. We would also be conducting a webinar on electric vehicles on 3rd of November at 3 p.m. So dear audiences, if you are interested to find out more about financing for electric vehicles, please scan the QR code and join us tomorrow. SBF and Clifford Capital will also be conducting complimentary business consultation session for your internationalization and infrastructure financing needs. So please contact my colleague Zichuan to register your interest after this webinar. If you would like to understand more about the SBF infrastructure team and the work that we deal with, please, could I have the previous slide, please? So please scan the top code to find out more about SBF infrastructure. And if you are interested to join our infrastructure interest group, please scan the second QR code. So this will lead you to an online form. And once you complete the registration, we would be able to keep you updated on our upcoming events and the project opportunities as they arise. Lastly, we would appreciate if you could take some time to fill up a short survey form administered by Forbes Research. We value your feedback, and this will help us to organize better events in the future. So this survey will only take you less than 5 minutes to complete. Once again, my name is Jeffrey from SBF, and I'm pleased to be your host for today. Thank you for staying with us over the past 60 minutes. Stay safe, stay healthy, and I look to see you, hope to see you again. Bye-bye.